Okay, I thought it would be wise to break down the difference between growth and value stocks before having a look at financial statements, the balance sheets, the cash flow, as well as income statements. So, when we talk about growth and value stocks, there are two distinct types of investments, each offering, different potential of rewards as well as the risk. But understanding the key differences between them and what to really look out for when investing in these types of stocks can really help you make a informed decision. So let's start with growth stocks. What are growth stocks? In essence, they represent companies that are expected to grow at an above average rate compared to the broader market. So if we take, for example, the FTSE 100 and it's up around 1%, growth stocks tend to be up 2, 3, 4, 5, 6%. They are higher beta, they tend to outperform. But on the flip side of that, and I will touch on the volatility element later, but if the market is to be down 1, 2%, these high growth stocks have a tendency to be down a lot more than the overall market. So there is that risk and reward element. These companies often reinvest their profits back into the business, really to fuel further expansion rather than paying dividends to shareholders. So if you are looking for income and dividends, growth companies are not going to be the ones that will, fulfill that strategy to the best of its ability. So some of the characteristics to really look out for: high revenue and earnings growth. They typically tend to experience rapid revenue and earnings growth. So that can be based on the fact that they are in an expanding market, innovative area, or based on new products. But whenever we talk about growth stocks, it's not always associated with companies within their infancy, startups. A lot of the growth companies and sectors are still very well established. The banking, the healthcare, the mining, the oil and gas. These are the sectors that also tend to do very well, as well as obviously tech. Low to no dividends. So whenever you're looking at a growth company, you're pretty much prepared not to expect any form of real income every year. If they do naturally distribute some form of dividends, it's hardly anything. Okay. As we know, they prefer to reinvest, and if I'm investing in growth companies, I prefer them to put their profits into new operations to keep going. So instead of taking 3, 4% dividend a year, I've already made 6, 7, 8, 10% on my initial investment just from pure growth. And if I keep doing that year on year, it'll be far better than just taking a 2, 3, 4, 5% dividend. A lot of growth stocks will tend to have high P ratios. This is because investors expect, higher future earnings. So as a result, these stocks can be more expensive, relative to their current earnings. And we will touch on a P ratio than earnings per share later. But be aware, growth stocks tend to have a higher P ratio. Market leaders, growth companies often tend to be in industries or emerging sectors like tech, healthcare, renewable. But as mentioned earlier, volatility is very much there, due to the high valuation and reliance on future growth projections, as well as the economies globally performing well. A downturn can massively affect them as a whole. So when you do look to invest, keep an eye out for revenue growth, earnings growth, strong market position. How well are they faring in their sector? Okay, how well are they doing against all their other competitors? That will be a good indication of if you are buying one of the better growth stocks. And whenever we talk about comparing ratios, be fully aware ratios should only be compared with companies within the same sector. It serves little to no point doing ratio analysis with the likes of United Utilities or National Grid, which are a utility based in the utility sector, with Anglo American or Barclays, which are in the mining and banking sector. Not competitors, completely different areas of business. So always do any form of analysis with companies within the same sort of sector. Okay, the next one will be value stocks. Value stocks often represent companies that are trading at a lower price relative to their fundamentals. So they will have, lower P ratios, but they will have high dividend yields. Investors consider these stocks to be undervalued by the market, making them potentially more attractive in the future. Undervalued stocks have potentially higher headroom, potential for further growth. Companies with a high, P ratio are sometimes considered to be overpriced. Not always the case. Okay, but if something is overpriced, the upside is very much limited. But be fully aware. A lot of these companies which are classed as value or defensive companies, they tend to do very well in a stagnant market. If the market is rallying or is collapsing, these companies tend to remain, relatively firm. Okay, so they fit a certain investor. Okay, and I'll come on to the pros. So some of the characteristics will be low P ratios, as mentioned. They're priced lower to their relative earnings. So there is that element of being undervalued. So many believe that the stock price is not fully reflected as of yet, and there is that upside. The big fact about a value company is the fact that it's a big dividend payer. They pay regular dividends, usually semi-annually, and they are always, or more often than not, very well established companies, consistently producing profits. So you got to remember, what sort of audience does a value um, strategy look like if you're focusing just on value stocks? It's individuals which are not looking to take a huge amount of risk, individuals that want elements of income as part of their portfolio. Okay, so that's one thing to keep a very close eye on. They are lower in volatility, not to suggest that they don't have any volatility. They are just lower. History shows that market collapses, value stocks tend to do very well. Even if the market rallies, yes, it does go. These stocks do go up as well in value, but maybe more mimicking the move of the market. If the FTSE is up 2, 3, 4, 5, 6%, these companies are probably up very much the same amount as well. Okay, so some of the key characteristics to look for is, low P ratio, as we've mentioned, but also a very high dividend yield. It's a positive sign. It indicates that the company is profitable enough to return cash to its shareholders. A solid bunch of fundamentals. So they've got the elements of growth. They're managing their debt and their solvency levels very well. So short-term liabilities, long-term liabilities are very much in check. They're very consistent with their performance, whether that be the P ratios and as well as their earnings per share. These are the factors we want to look for. And finally, cyclical elements, meaning that they are very tied to economic cycles. So as mentioned, if we do see some form of economic backdrop or pullback, selecting value stocks will have a tendency to perform better overall. And so the final question you would be asking is, which should you choose? Or which one should your investors choose? Um, well, a lot of it will depend on your investment goals, your risk tolerance, and your time horizon. When it comes to growth stocks, they're ideal for investors looking for higher returns and willing to accept more risk and volatility. These stocks offer a potential for significant capital appreciation, but can be susceptible to market downturns and quite aggressive market downturns. When it comes to value stocks, they're more suited for investors who prioritize safety, steady returns, and more long-term wealth preservation rather than needing accelerated growth. As value companies do provide good, solid dividends, less volatile. Upside may be a lot slower and less dramatic than growth stocks, but that's absolutely fine. Okay, we always tend to focus very much on having a balanced approach. Many investors do choose to have a certain percentage dedicated to each arena. You've got to diversify your portfolio. Okay, have elements of growth that do cater for those higher returns, while value stocks will provide you with the stability and the dividend. And the aim is to reduce overall portfolio risk. That is the aim. Okay, so whenever you are speaking to investors, whether you are trying to convince them to come on board as clients, explain to them how you go about selecting growth stocks. How you tend to target companies that are doing well individually within their own sector. You target companies with, strong earnings per share, with slightly higher P ratio, not really high P ratio. Then we'll come on to that. Understand, look, so if the market is set to rally based on all the economic data that we've seen over the last number of weeks, as well as interest rates being lowered, there is the chance that the markets globally could keep going up, and that sort of rally tends to favor, or growth stocks tend to be part of that rally. So you want to be in that sort of arena. But if we are going to see some form of market instability, market pullback, we can position portfolios towards value stocks. Start to focus more on the income. Long-term wealth preservation. Okay, so always build scenarios and portfolios for your clients, but as always, try having a balanced approach rather than being always directional.